If you're watching this right now, you're early, and that matters more than you think, because in just a few hours, silver erased roughly $21. Not over weeks, not over days, hours. And the real reason it happened isn't what most headlines are blaming. This just unfolded. The dust hasn't settled yet. And I want you to understand what actually broke, why it broke so fast, and what this kind of move usually signals next. Stay with me, because I'm going to show you how to recognize this pattern the next time it shows up, before the crowd even realizes it's forming. If you're holding silver, if you're stacking physical, if you're watching metals markets trying to understand where this goes, your job right now is to understand the mechanics underneath the chaos, not the headlines, the mechanics. Now, before I explain what caused this, let me teach you something most people never really internalize about markets. Price doesn't move because of opinions. It moves because of positioning. You can have strong fundamentals, rising demand, bullish narratives everywhere, and still get absolutely crushed if too many people are leaning the same way at the same time. Think of it like this. Imagine a crowded theater where everyone suddenly runs for the exit. The building didn't change. The movie didn't change. But the movement becomes violent because there's no room to move safely. That's what you need to understand about parabolic rallies. They don't just rise fast, they build tension, and tension eventually releases. So when experts look at a move like this, they're not asking whether silver is good or bad. They're asking how many people were stretched too far, all positioned the same direction, all using leverage to amplify their bets. Because when that structure tips, it doesn't tip slowly. If this is making sense so far, drop a comment below and let me know where you're watching from. I'm genuinely curious how many of you saw this coming versus how many got caught off guard. Here's what you need to know about leverage. When prices rise quickly, traders don't just buy more, they borrow more. Futures, options, margin accounts, paper contracts stacked on top of each other. It feels smooth on the way up because liquidity is abundant and confidence feeds on itself. Everyone's making money. Everyone's talking about new highs. But that structure is fragile. It's like stacking cards higher and higher while telling yourself the table is perfectly stable. It works until it doesn't. Now here's what's actually happening. Silver had just gone on a historic run, pushing up toward that $120 level in a near vertical move. Momentum traders piled in. Funds chased performance. Retail got excited. But at the same time, the US dollar suddenly surged and bond yields jumped hard. That combination matters more than most people realize. See, a stronger dollar tightens global liquidity. It makes everything priced in dollars relatively more expensive. Rising yields raise the cost of holding leverage positions. They increase the opportunity cost of holding non-yielding assets like metals. So, when silver failed to hold that 120 level, it wasn't just a technical rejection. It was a trigger. Let me break down the sequence for you. First, price slips below a key level everyone's watching. That alone causes short-term traders to bail. They were there for momentum, not conviction. Then stop losses start firing automatically. Those sells push price lower, which triggers margin calls on leveraged longs. And here's the thing about margin calls. Those traders don't get a choice. They're forced to sell. Doesn't matter if they believe in silver long-term. Doesn't matter if fundamentals are strong. They have to exit or get liquidated. Liquidity thins out because buyers step back. Nobody wants to catch a falling knife in real time. That makes every sell hit harder. And suddenly, what looked like a healthy pullback turns into a waterfall. That's exactly what you saw as silver dumped $21 in a compressed window. This wasn't gradual. This was violent. Here's what's wild about this. And I need you to really hear me on this point. Physical demand didn't suddenly vanish. Industrial use didn't collapse overnight. Mining didn't stop. This was paper. This was positioning stress. This was too many contracts trying to exit through too small a door at the same time. And here's the part that should make you nervous, or at least alert. When momentum flips this fast, it tells you how stretched the system had become beneath the surface. It's like pulling back a curtain and seeing all the leverage that was hidden when everything was going up. Now let me show you what very few people are talking about yet. Open interest in silver futures had climbed to extreme levels during the rally. That means there were massive amounts of paper contracts outstanding relative to actual physical silver. When you've got that kind of ratio, you're not trading metal anymore. You're trading sentiment and leverage. And sentiment can flip on a dime. The second confidence cracks, all that paper wants to become cash, but there's not enough liquidity to absorb it smoothly. So you get what we just saw, a flush. This is the exact same playbook that showed up during the 2011 silver spike. Back then, silver surged from around $30 to nearly $50 in a matter of weeks. Retail investors piled in. Momentum was insane. And then what happened? Exchanges raised margin requirements. Suddenly, holding leverage positions became more expensive. Traders got forced out. Silver collapsed from 50 back down to the mid-30s in days. Sound familiar? It should, because the pattern's identical. Parabolic rise, extreme positioning, liquidity shock, violent unwind. You saw it again in crude oil during the 2020 liquidity shock. Oil went negative for the first time in history. Not because we stopped using oil, not because supply flooded the market overnight, but because futures contracts were expiring and nobody wanted to take physical delivery during lockdowns. Forced selling overwhelmed fundamentals, leverage unwound, same mechanics. You even saw echoes of it in crypto cycles. Bitcoin in 2017 went parabolic into 20,000, then collapsed to 3,000. In 2021, it ran to 69,000, then crashed to 15,000. Every single time, the story is the same. Extreme upside builds fragile structures. Small shocks expose them. Leverage unwinds. And the larger story is never about demand disappearing. It's about excess getting flushed. When you zoom out and look at these events across different markets, you start to see it's not about the asset. It's about the behavior around the asset. Now, let me be skeptical for a moment, because I want you to hear independent thinking, not just hype. Could this just be manipulation? Could this be some coordinated attack on silver by big banks or institutions trying to protect short positions? Let me be honest with you, maybe. There are always questions about how metals markets operate, especially when moves are this extreme. Could regulators or exchanges have changed something that triggered this? Yes. Could there be players with enough size to intentionally shake out weak hands? Sure. But here's the thing. Markets don't need villains to break. They break under their own weight. Focusing on who to blame doesn't help you position better. It doesn't help you recognize the pattern next time. What does help is recognizing when leverage is extreme, when momentum is crowded, and when macro conditions start tightening at the same time. Those are variables you can track. Those are signals you can act on. Focus on what you can control, your risk, your sizing, your timing, not conspiracy theories about who's pulling strings behind the curtain. There are probably 3 types of people watching this right now. Let me speak to each of you directly. First, there's you if you chase the move late and you're feeling punched in the gut right now. Maybe you bought silver above $100, thinking it was going to $150 or $200. Maybe you loaded up on call options or leveraged ETFs. And now you're watching your position bleed. If that's you, I want you to hear this. You're not stupid. You didn't do anything crazy. You got caught in a momentum unwind. It happens to professionals too. The lesson here isn't to beat yourself up. It's to respect key levels and never assume parabolic moves slow down gently. They don't. They either keep going or they reverse hard. There's rarely a soft landing. Going forward, define your risk before you enter. Use stops, size appropriately. And don't marry a position just because you believe in the narrative. Second, there's you if you sold near the highs and you're wondering if you should buy this dip immediately. Maybe you took profits at 115 or 118, and now you're watching silver in the 90s thinking this is a gift. For you, patience matters. Forced selling often comes in waves, not just one flush. The first drop shakes out the weak hands. But sometimes there's a second wave when people who held through the first drop finally capitulate. Watch for stabilization. Watch for volume to dry up. Watch for open interest to decline, because that tells you leverage is actually being cleared out. Don't rush back in just because price looks cheap compared to where it was yesterday. Let the dust settle. Third, there's you if you never touch silver and you're just trying to learn how markets work. If that's you, this is gold, no pun intended. You're seeing in real time how markets really behave under stress. You're learning that headlines lag reality. You're learning that fundamentals don't protect you from technical breakdowns. You're learning that leverage amplifies everything, both up and down. Take notes. Watch how this unfolds over the next few days and weeks. because this pattern will show up again in other markets and you'll recognize it. The universal principle for all of you is the same. Price moves fastest when leverage unwinds, not when fundamentals change. Fundamentals are slow, positioning is fast. And when positioning breaks, it doesn't matter how bullish the long-term story is. So here's what I want you to answer in the comments. Where are you in this? Did you ride it up and get out? Did you get caught? Are you waiting on the sidelines? Let me know, because I'm genuinely interested in how this community is navigating this. So here's where I stand. I'm not panicking, and I'm not blindly buying either. I'm watching. Let me tell you what I'm personally monitoring right now. First, I'm watching whether silver can stabilize without another margin-driven flush. If we see price hold above a certain level, let's say mid-90s for more than just a few hours, that would indicate some of the forced selling has exhausted itself. Second, I'm watching the dollar and yields closely, because if they keep ripping higher, pressure stays on risk assets and commodities. A strong dollar and rising yields create headwinds. If those reverse, that changes the picture entirely. Third, I'm monitoring volume and open interest in the futures markets, because that tells you whether weak hands have actually been cleared out or whether there's still a lot of leverage sitting there waiting to unwind. Based on my analysis, this drop was mechanical, not emotional. It was structural, not fundamental. The fundamental picture for silver hasn't changed. Industrial demand is still strong. Green energy transition still needs silver. Solar panels, electric vehicles, electronics, all of that still requires massive amounts of silver. Supply is still constrained. Mines aren't ramping production overnight. The deficit story is still intact. What changed wasn't the thesis. What changed was the positioning and the macro backdrop with the dollar and yields. If history rhymes and silver can stabilize and base here after clearing out excess leverage, the move that follows could be significant. I'm not making a prediction. I'm telling you what the pattern usually looks like. When you flush out weak hands, when you reset sentiment, when you give the market time to digest and rebuild, that often sets the stage for a healthier move later. Not immediately, not tomorrow, but over time. I'm not a financial advisor. This is not financial advice. I'm a guy who studies markets and tries to understand patterns. You need to do your own research. You need to make your own decisions based on your own risk tolerance and your own financial situation. Don't take anything I say as a recommendation to buy or sell anything. If you made it this far, you're the type of person who wants to understand how things actually work, not just chase headlines. That mentality will serve you well in markets and in life. If you found value in this breakdown, do me a favor. Share this with someone who's trying to make sense of what just happened. Subscribe if you want more real-time analysis like this. And stay ahead of the noise, because the next big move is always forming while everyone else is still talking about the last one. Think critically, verify the data, make your own decisions. Stay sharp out there.